and good afternoon, everyone. So welcome, yes, to today's session, which is all about minimising investment risks. Now, for anyone who hasn't been to one of these sessions before, to briefly introduce myself, I'm Amy Staines, and I'm the Senior Financial Education Manager at Better With Money. And Better With Money is an independent financial education company, and we provide support to help bring money matters to life and hopefully help to reduce any money stress you might be feeling. Now, a couple of housekeeping points before we start. So first of all, today's webinar is providing information only, so I won't be providing any sort of financial advice today, but rather I'm aiming to give you the tools and hopefully the knowledge to help you take control of your finances and make your own decisions. Also, Better With Money is independent, so we don't have any products to sell. So if I do mention any websites or companies as we go through the session today, that's because we genuinely believe they offer really useful services which you can take advantage of, rather than because we have any sort of financial incentive to do so. And as you know, the session is being recorded, so you will be able to watch it back, and there will also be that time for Q&A at the end. So, what are we going to cover today? So we're going to start with a reminder of what investing is before looking at the different risks associated with investing. And we'll then go through 5 tips for minimizing investment risks before moving on to that Q&A. So, for anyone who wasn't able to join the Beginner's Guide to Investing session back in April, I did want to just start with a reminder of what investing actually is. And to do that, I wanted to draw a comparison to saving. So, saving is simply a way of storing our money until we need it. And this usually means putting our cash into some sort of savings account, and we may receive some interest income on that cash. Now, saving is low risk because the balance of our savings won't go down. We know exactly how much they're worth, and we can be sure that our money is safe. Now, in contrast, investing is putting our money into something other than cash, usually with the aim of making your money work harder for you and getting a better return than cash would attract. Now, there are many different types of assets you can invest in, so property, gold, stocks, bonds, and the biggest difference between saving and investing is the level of risk involved. Because whilst with saving, as we've said, you know your cash is safe, it's low risk. With investing, you're exposing your money to a higher level of risk in the hope of getting that higher return. So risk is fundamental to investing, but what does risk itself actually mean? Now, in general, risk is often described as a measure of the chance of something going wrong. And in everyday life, we face and manage risks all the time. The risk of missing your train, the risk of getting caught in a rainstorm. In fact, few things in life come without any risk at all. And the same is true of investments. Now, investment risk specifically is defined on the FCA Invest Smart site as the likelihood of something you've bought not performing as you'd expected, particularly if it loses money. And when thinking about investing and the risk involved, there is a very simple trade-off which you should understand, and that is the trade-off between risk and reward. So you can see on the slide there. Now, quite simply, the higher the risk you take with your investments, the higher the potential for returns. But on the other hand, the higher that risk, also the greater the chance that you won't get back as much as you put in, because it also means the downside risk is greater. And so this also means that if you take on less risk, you're less likely to experience the downside, but you're also less likely to achieve high returns. So when thinking about investing, you should always keep in mind this relationship between risk and reward. And as part of this, it's also extremely important to understand and consider your own risk appetite. And your risk appetite includes both, one, how risk makes you feel, but also, two, your capacity for loss. So in other words, how confident and comfortable do you feel taking on risk? Does that thought keep you up at night? But also, if your investments did fall in value, are you in a financial position where you could absorb these losses comfortably? Or would that loss actually have a major impact on your finances and your quality of life? So risk appetite, it will differ from individual to individual, depending on your own financial situation and your personal circumstances. And at this point, I also just want to highlight the FCA Invest Smart website, which I've linked at the top of the slide here, and it has a really great page on risk and return if you would like to read more. So now we've set the scene. So we know about investment risk. So let's now look at some of the different risks associated with investing. And in general, there are 2 broad categories of risk under which most other types of risk fall. And these are systemic risk and non-systemic risk. So the first one, systemic risk, sometimes referred to as market risk. So this is the risk that affects almost all types of investment in the same way, because it's the risk inherent to the entire market. So the global financial crisis of 2008, the COVID pandemic, both examples of systemic risk because they impacted pretty much every investment out there and every player involved in the market. Now, other sources of systemic risk include global recessions, natural disasters, interest rate risk, exchange rate risk, and also geopolitical risk as well. Now, these risks are actually very difficult to avoid. And in fact, there will always be some level of systemic risk when it comes to investing, regardless of the measures we take to minimize risk. And in reality, the best way to minimize systemic risk is by not investing at all. So it is important to be aware of this systemic market risk and feel comfortable taking that on. And if you do feel happy taking these types of risk, you will usually be rewarded with higher returns. So as we've already said, compared to cash, for example. Now, in contrast, there's non-systemic risk. So these are those that are unique to a particular company or industry, or perhaps a small segment of the market. So if we take the 2010 BP oil spill in the Gulf of Mexico as an example, this caused the share price of BP to fall by 20%. It also had some impact on the oil sector a bit more broadly, but the difference here is that it didn't have systemic repercussions for global markets. And other examples include if an individual company had management problems, for example, or found itself facing legal action. And the good news here is that non-systemic risks can largely be avoided by creating diversified portfolios. And we're going to go on to talk about that. But before that, I do also feel it's important to just acknowledge the risk of fraud and scams when it comes to investing as well, particularly as more and more fraudulent schemes are cropping up, including on social media. Now, fraud risk refers to the possibility of financial loss due to intentional deception by criminals. So, for example, fraudulent schemes might promise really low risk but really high returns, but in fact, that money might not even actually be invested. So, it's really important to understand the different types of risk you might face when it comes to investing. And again, if you'd like to read more, there's a really great article on the Motley Fool website all about the different types of risks. But now we know the risks, let's look at how to minimize these. And I'm going to go through each of these points in turn. So, first of all, diversification. So this is the idea that you aren't putting all your eggs in one basket. So you might have heard that idiom, don't put all your eggs in one basket. And that really is the basis of diversification. So this is the idea that you can reduce risk across your investment portfolio by investing in different types of assets across different geographies and different industries. Now, why is that the case? Well, it's because if one particular investment or geography or industry or market segment performed poorly, then the performance of your other investments can help to mitigate the impact of these losses. So essentially, you're diluting the impact of negative returns and performance because you're not concentrating all the investment risk in one place, and you're reducing the chance of a single investment heavily impacting your portfolio. And a truly diversified portfolio is thought to contain at least 20 to 30 different assets. So something to bear in mind, the portfolio will need to contain different assets to be truly diversified. So that's diversification. So the next way to minimize investment risk is by using a pound cost averaging method of investing. Now, pound cost averaging may sound like complicated investment jargon, but it's actually a very simple concept. And it's the strategy of regularly investing small amounts of money over time. So rather than investing a single lump sum, for example, this is about regularly drip feeding smaller amounts of money into your investments. But again, how does this actually help to minimize risk? Well, whilst the ideal when we're investing would be to invest when markets are at a low and sell when markets are at a high, in reality, it's pretty much impossible to invest at the perfect time. But by contributing to your investments regularly, you will sometimes be purchasing investments at a lower price. You'll sometimes buy them at a higher price because markets are constantly going up and down in the short term. And buying into investments at different points can help iron out some of the bumps in the market because it, again, diversifies the prices at which you're buying into that investment. And this is a really disciplined approach to investing, which also takes some of the stress away about predicting the best time to invest. And it also helps to avoid making emotional investment decisions as well, because instead you're committing to investing on a regular basis. So, for example, you might have a direct debit that's set up to invest a certain amount every month. So you're not trying to time the market and you're able to spread some of that risk. So that's diversification and pound cost averaging. And we've seen that it can be really difficult to time the market. And we've seen, therefore, how that pound cost averaging can help spread that risk. And so we're now building on this with the next point, which is all about taking a long-term approach to investing. So as I've already said, markets can be volatile in the short term, and volatility refers to the fluctuations in the value of investments. So where the value of investments goes up and down. But in general, even if there's short-term volatility, markets have historically recovered and trended upwards over the long term. And it's for this reason that patience really is key when it comes to minimizing investment risks. And that's because a long-term investment strategy can help you to override some of that short-term volatility. So the key here is really to keep your long-term investment goals in mind and stay invested for the long term, even if you see kind of turbulence and volatility in the short term. By staying calm and not making those impulsive decisions during market turbulence, you're actually giving your investments the chance to recover and grow over time. And if we contrast that with taking a short-term approach, and perhaps you decide therefore to disinvest when markets go down, this will just cause you to miss out on any future gains because all you're doing is crystallizing losses at the low point and removing that opportunity to benefit from any market recovery. And another benefit of long-term investing is also the impact of compound growth, which is far more prevalent over the long term. And compound growth is essentially when you receive growth on existing growth. And so the longer you can remain invested, the more likely compound growth is to happen. So really, really important, again, when thinking about minimizing investment risks, to take that long-term approach and keep those long-term goals in mind. So let's now move on to the next point, which is to do your research before you invest. And it's incredibly important to educate yourself about the investments you're considering to ensure that any decisions you make are fully informed, because investing without knowledge can increase risk. So whilst you're doing your research, you might want to consider historic data relating to that particular investment, perhaps current market trends, future prospects for the particular company, perhaps that you're looking to invest in, future prospects for that particular fund. Whilst you're doing your research, though, it is really important to keep in mind that historic performance isn't necessarily a reliable indicator of how an investment might perform in the future. But this is all about making sure that any investment you make aligns with those financial goals and that risk tolerance that we spoke about at the start as well. And this step will also minimize that risk of falling victim to a scam as well, or some sort of fraudulent investment scheme, because you will hopefully, through research, identify that those schemes that are perhaps too good to be true. And so that brings us on to the last point around seeking the expertise of a qualified financial advisor. And this really can be invaluable when it comes to managing investment risks, because financial advisors can help you with everything we've covered. So helping to identify your own attitude towards risk, your attitude towards that risk reward trade-off, assessing your individual circumstances as well. But also, they can help you on a practical side by building that diversified portfolio. As we said earlier, diversification requires 20 to 30 different assets, which for an individual can be tricky, but actually these financial advisors can help to build that and identify those assets that are right for you. And not only that, but they can also provide ongoing monitoring of your portfolio to help identify situations where perhaps your investments might start to exceed your risk tolerance. And they can, in cases like this, look to take the necessary steps to rebalance your assets in line with your risk tolerance, where things perhaps start to kind of deviate from your original plan. And we did run a session in May on financial advisors. So it is worth taking a look back at that if you are wondering how to find one. And you could also visit the website on the slide there, which is unbiased.co.uk. So, minimizing investment risks. There are lots of risks out there, but broadly, they're split into those two categories of systemic risks. So those ones that are inherent to the market, the things like natural disasters, pandemics, financial crises. These are the risks that actually, when you're investing, you need to be comfortable taking, because that is really what differentiates an investment from keeping your funds in cash. But there are also these non-systemic risks. So they're the ones that perhaps are only relevant to a small section of the market, a certain industry, a certain geography. And these are the ones that you should be looking to minimize so that you're not taking unnecessary risk. And as we've said, the key ways of doing this are, first of all, diversification. So making sure you're not putting all of your eggs in one basket, making sure you're buying different types of assets in different geographies, perhaps different industries, to make sure that you're minimizing the risk that any one single investment will have a catastrophic impact on your overall investment portfolio. The second point was pound cost averaging. So that's the idea that you drip feed money into your investments regularly, and this helps you stop trying to time the market. Now, you may have heard the phrase time in the market, not timing the market. And pound cost averaging really does help with that, because as we know, trying to time the market, trying to identify the perfect point to invest in particular assets is near impossible. Now, the third point, investing for the long term. So this is trying to look past any short-term volatility and keep focus on your long-term goals. Because actually, if you act with your emotions, if you allow that short-term market volatility to impact your investment decisions, then actually, as we've said, you may find that you are simply crystallizing a loss and removing any sort of opportunity to allow your investments to grow over the longer term. Now, point 4, all around doing your research and understanding what you're investing in and the risks involved. And as we said, this is a really, really important point, because it can help highlight any schemes that perhaps are too good to be true, are perhaps scams, are fraudulent schemes, but it also can help instill a sense of confidence in what you're investing, because you know when you're making that particular investment, you are fully informed and aware of the assets you're investing in and what those risks might look like. And finally, we spoke about seeking the expertise of a financial advisor. And again, I'd urge you, if you are interested in looking for a financial advisor, to look back at the session from May, where we looked at this in a lot more detail. But financial advisors really can help you with everything from identifying your risk tolerance, identifying your attitude towards risk and reward, to actually forming that diversified portfolio and keeping an eye on things going forward as well. Again, providing that peace of mind that someone is looking after your investments. But before we kind of move on to draw the session to a close, I do urge you to keep in mind, however, that none of these Points will eliminate that investment risk completely. And there is no guarantee against loss when it comes to investing. So even taking these steps, you could still get back less than you invested in the first place. And so you must still be really comfortable with the reality of investment risk. And as I said right at the start, if you don't want to take any sort of risk, if you aren't comfortable with the concept of investment risk, then actually it might be that investing isn't for you. Now, before we go to questions, just a reminder of the support you have access to via the ICE Benevolent Fund and Support Network and the contact details I've listed on the slide here. But I'm now happy to take any questions.
Oh, brilliant. Thank you, Amy. We've had a couple of questions through, one of which was, would you consider investing in a single diversified fund, sufficient diversification?
Yeah, so a really good question. And actually, funds can be really good ways of achieving diversification because funds work by investing in lots of different assets. Now, one thing I would say when thinking about investment funds is you should kind of try and look under the bonnet at what that fund is all about. Because some funds might, for example, focus in a specific geography. They might focus in a specific industry. So in that way, the fund might not be as diversified, perhaps. Say it's a fund that focuses on kind of pharmaceuticals, for example. If something happened in the pharmaceutical sector, then the diversification perhaps might not be quite as much if you invested in a fund that had exposure to pharmaceuticals and other industries as well. So as I say, very much worth looking under the bonnet at what the specific fund is, what it's invested in, and kind of making that judgment call on actually, is this sufficiently diversified for my needs? Is it across geographies, sectors, different types of assets? Some funds, for example, again, are only in equities, for example, so they wouldn't contain the diversification offered by bonds. So really it's making sure that you feel comfortable with the level of diversification, but in general versus say specific individual stocks being purchased, often funds do offer a really useful way of providing diversification compared to if you were to do that on your own.
Brilliant. That's great. Thank you, Amy. Can you recommend any trustworthy resources to find out more about investing in a safe way?
Yeah, another great question, and actually a really sensible question, particularly as I mentioned around the kind of fraud and scams point. But there is also more and more cropping up, and I'm sure lots of you will have seen it around investing on social media. So whether that be kind of Facebook, Instagram, TikTok more recently as well, and some individuals are actually claiming to be investment experts. But in reality, many of them are probably not experts, and they may even be getting paid to talk about particular investment products, for example. So it's really important to be wary when it comes to where you're actually going to learn more about investment. So as I say, really sensible question. And it's for those reasons really that I personally tend to stay away from social media. That's not to say that every finfluencer, as they're called, is bad. There are some really good ones out there, but I tend to use the following websites. So my favorites are FCA Invest Smart. I did actually link that on one of the slides earlier. Fantastic website, backed by the FCA themselves, so Financial Conduct Authority, the UK regulator. So you can be sure with something like that the content is really informative, but also has that independence as well. A similar resource that's really good, it's the Money Helper website. Again, backed by the Money and Pensions Service, so really independent, but really informative stuff. And Money Helper, slightly different to Invest Smart, actually has, loads of different topics on much more broadly than just investing. And then the others as well that I like to use are Investopedia and Motley Fool as well. So they have, again, some really, really great stuff on there all around investment risk, different investment assets. But yeah, as I say, look for those resources if you can that perhaps do have a link to, a really reputable source like the FCA or the Money and Pension Service, because that's when you're getting really accurate information.
Brilliant. Thank you, Amy. Maybe we can send all those links out when we send the recording of today's webinar so
Absolutely.
that everybody can have a look at those great websites. We've got time for just one more question, and that is there a standardized definition of sustainable investment?
Really interesting question. And I would say no, because sustainable investing incorporates lots of different factors. And in fact, between kind of investment manager to investment manager, they may have a slightly different take on sustainable investing. So, for example, some firms may have a single fund, for example, or single product that they have labeled as a sustainable investment, for example, but this doesn't necessarily cover um, all of their investment products, whereas other asset managers or investment managers may actually incorporate a sustainable investing approach across their whole fund range. So it really does depend on the specific kind of asset manager, the specific product. And, again, sustainability as a concept can be interpreted in different ways depending on the firm again. So is sustainability focusing on climate? Is it focusing on kind of other sustainability factors? So in that's a very long way of saying no, there isn't a standardized definition, but there are kind of trends, I would say, in terms of the types of themes you might come across with sustainable investing. And again, the approach different asset managers take when it comes to investing sustainably. And often it boils down to that house view of that specific investment manager and kind of how they view, sustainability over the long term and the impact they think that will have on investment returns.
Brilliant. Thank you, Amy. Really quickly, if you don't mind, we've just had one more question through. How do you measure diversification to ensure that portfolio is well diversified?
Yeah. I mean, follows on really well from obviously what we've been talking about. So I mentioned earlier that the guidance for a truly diversified portfolio is something that contains at least 20 to 30 different assets. So that's kind of at your very basic level what you should be looking at. And in general, most funds do contain at least that. So if you're looking at a fund often, that covers that 20 to 30 assets. But as I said earlier, I think it then kind of boils down to your own feelings around diversification to some extent. Are you looking to diversify across sectors, geographies, industries, different markets, or actually do you feel more comfortable looking at different companies within a specific sector, for example? But yeah, bottom line is kind of 20 to 30 assets is the guidance for diversification. But lots of, again, investment managers will go far above and beyond that. And every asset that's added really increases that diversification benefit, because the lesser the impact if one particular investment within that particular fund, for example, failed, the impact's diluted further the more assets are added.